Peter, you're a 20-year veteran in Europe. You've been involved in the secondaries world for the last 10 years specifically, HarbourVest since 1996. So you've got a good long perspective through the cycles. What's your assessment of today's secondaries market?
Yeah, I was just involved in a panel on secondaries half an hour or so ago, and kind of felt like a number of us would have walked out of there quasi-slitting our wrists just listening to how difficult it is on the buy side. And it kind of reminds me that if you are standing still in any industry, and secondaries is absolutely no exception, chances are you can get run over by an intermediated bus. But our job actually is to not stand still. And in fact, I think whether it's pricing dynamics or capital or funds flow dynamics, where there are things that look like they're running a bit against you, your job is to find ways to still figure out how you can generate returns for investors. And there have been different points in the cycle in the last several years where, back to 07, 08, there were a lot of staple transactions being done. Some haven't worked out, but some have been not too bad. You move on to secondary directs, which became another theme in the market that have gone quite well for some folks. You look at a newer wave, what we would call GP-led restructurings, that have also now become a theme or an opportunity. And we were fortunate to work with you guys on one such trade last year that I think has the potential to be a pretty satisfying outcome for everybody. So, amidst the macro level challenging opportunities, I think you shouldn't lose sight that hopefully the good firms are still looking for and finding ways to innovate, to find new inefficiencies where there's still opportunities to capture value.
And what are the facts on the ground? What is the level of dry powder? Is it at a cyclical peak?
The data I saw today spoke to about 40 plus billion of dry powder, which would be about a 1.5 times multiple of the transaction volume of the previous year, which looks to be at close to a record high. There's talk that you probably know of some folks in the market that are again raising very large pools of capital, 7, 8 billion. I don't think that dry powder number is going to change too much over the course of the next couple of years. The challenge is, what do you do with it, and how do you find those pockets? We're typically successful on about 1 to 2% of the deals we actually end up looking at, and hopefully, if we're able to find that right 1 or 2%, even as someone said, even a blind hog finds a truffle every now and again. So that's really...
Well, 1 to 2%, that's a remarkably low hit rate. You've got to be pretty darn patient.
Yeah, you have to manage the team pretty well because they're unsuccessful and depressed 98% of the time.
Right.
But that's the business. It's about putting your resources in the right places where you think you've got the best chance to win.
Well, I'm no expert, but I have watched this market at a distance, and I would quote Twain in saying, rumors of my death have been grossly exaggerated. The death knell has been pronounced repeatedly. Post the recovery after the dot-com crash, and so on and so on. So, looking ahead, what are the drivers of flow? Are they regulatory? Are they corporate restructuring, portfolio restructuring? Yeah,
I think two things. The drivers of flow are what you said. There's regulatory. There's greater interest on the part of sellers to test the market, given they've heard or they believe that pricing is pretty good. But it's not just kind of the drivers of deal flow. To me, it's sort of where are you identifying opportunities? And that goes back to sourcing. What are you trying to do to hopefully build in as proprietary or quasi-proprietary a scenario as you possibly can? And if you're able to do that, then you've got obviously a better chance of getting a transaction done at a price that you might not be in love with, but at least you feel you can do and still meet the return expectations of your investors.
Over the last 10 years, how have you had to change your team structure? What different skills are needed today? Yeah,
it's for us specifically, we've gone from a team that I think put portfolios together that were predominantly traditional LP deals to a team now where the deal portfolios we put together are probably 2/3 secondary directs, or what we call structured transactions, more specialized deals, and about 1/3 traditional LPs. And that's meant that the skill set has moved towards more of a direct deal orientation, more kind of senior level involvement to make sure you're engaging properly with sellers, and guys who are able to really get deep into the weeds on individual companies. And that's been the formula that hopefully will be successful for us.
And just a final quick question. Are you in the, look versus history, in the return appreciation, return stasis, return depreciation camp
within the
secondary
world? I would be naive to say that we're in a kind of a return world that looks like 10 years ago. It doesn't. It is in aggregate or in absolute a lower return environment. Do I think that secondaries still have an ability to outperform a kind of a liquid benchmark, a public market benchmark to the tune of 400%, 500%, 600%? I think absolutely yes.
Great.